FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 1/29/20 month. Just 2 days to go, and off to a bang already. Got all sorts of black swans circling. Interest rates appear to be headed even lower, if that is indeed possible, especially with the latest health scares going on out there. What else can the central banks do but cut their rates? And if you're looking at real estate, then that can have profound consequences, some on the upside and some perhaps on the downside, in the form of higher prices and higher demand, which makes it more difficult to find better priced properties. Well, here to talk about that is our good friend, Buck Joffrey. Buck, it's great to have you back. Hey, if you got a question for Buck or myself, email us. It's easy, kl@kerrylutz.com. So, Buck, looks like the U.S. has the highest interest rates of virtually any country out there in the world, and you think they can't go lower, but perhaps they can.
Yeah, I think that's a really good point, Kerry. The conventional wisdom when you look at interest rates is, gosh, I mean, we're at historical lows. What can we possibly, how can we actually go lower than we are? Well, the answer is, if you look around the rest of the world, we're actually just got the highest interest rates still. It's sort of like we're like the best looking in a group of really ugly people. And what that means in real estate is really interesting, because if you look in terms of what we do, what I do, what my group does, we're in we're into the larger residential properties mostly, that the prices are driven entirely by capitalization rates. And if you look at historical cap rates compared to where we are now, there's no arguing. We are definitely, compressed and despite that, people are still chasing yield. And the danger, of course, is that all of a sudden interest rates, start going back up. And why is that? Well, interest rates going down typically means that, capitalization rates are going down. If they go up, it means it goes up. So if people are buying at cap rates of 5.5, and the next thing you know, your cap rate's at 7.5, then you all of a sudden have got an asset that has lost a tremendous amount of value. So what do you do? Right. I mean, and that's one of the questions that's coming up. The problem is, fundamentally, I don't think that anybody, I don't know if you can, I can't predict the future. And you and I have been talking for a few years now, and I think we could probably have had this same conversation a couple years back. And in the meantime, people who have not been terribly risk averse, who've said, okay, it is what it is. I'm going to invest in quality assets in nice areas and try to increase their value and decompress cap rates dynamically, have fared extremely well during the last few years. So that's the real issue. And if, again, the idea here, in my view, is that I don't actually think that, interest rates are likely to go up. I think if you look at the global trend, they're likely to go down. And what that means for real estate is continuing downward pressure on the cap rate. So if you already own real estate, that is good news. If you don't, that's not very good news. But that's kind of my view on it.
Interesting. So Yogi Berra once said, prediction is very difficult, especially about the future, right?
Yeah, right.
And, I think that yogiism really holds true for right now, especially because usually most people, whatever they believe, they're wrong. Eventually, the market always seeks to frustrate the largest number of participants. You think this time is going to be another one of those?
I don't know. I mean, listen, I think it is a little bit of a game of musical chairs, right? There was plenty of people 5 years ago, 4 years ago, maybe 4 years ago, probably better, maybe 2016, that we're really beating the drum that this is it, that we are, we're at the top of the cycle and there's nowhere to go but down. But if you bought property in 15, 16 and, did some things and you sold now, you made a ton of money. And we've done that. And so, yeah, I mean, I think it's a little bit of a guessing game, but then you alluded to a number of other factors that we have to consider. Geopolitical, what happens in an increasing politically polarized world where, a candidate from the Democratic Party actually is, let's say it's a Bernie Sanders or a Elizabeth Warren, where, it's a very realistic proposition.
Bite your tongue.
No, I'm just saying, like, hey, I don't want it to happen. I'm just saying, realistically, like, people are like, this is crazy. I mean, I've never seen socialists talk like this in coming out of, so many mouths in my lifetime. Well, and I'm a Gen Xer, right? And back in the day when I was young and people were kind of fed up with the two-party system, we turned to Ron Paul. And this is the opposite, right? This is the generation of give me something for free. So I'm a little worried about it. If you look at these candidates, so, you get, Bernie out there against Trump or something like that. Is it a guarantee that Trump's going to win? Well, I don't know. I don't really know that. There's a lot of like crazy burners out there, right? At any rate, I think you look at the geopolitical side of it. You mentioned the health scare. I think that probably slows down the economy. I don't know if it necessarily should, but I think it does. I think you look at like the indicators right now, showing like, some industrial kind of slowing down, those kinds of things. There's lots of reasons to be concerned. And as you know, we have, going back to the election times inherently are uncertain, right? So I don't know. I think it's a tricky time. I think if you're real conservative, you don't buy anything of significance until October, November, until we have some clarity at least on that. But it's you always have the risk of losing out, right? So.
Mm-hmm. Yeah, agreed there for sure. But I just don't, from this current crop of candidates, I don't see much threat there. But hey,
you might be right. Yeah,
they're not serious candidates. They're not candidates that really have great wide appeal. They have zero charisma, and they're just, they're just really not happy.
The other thing to talk about in terms of interest rates, I think, Kerry, which I think you probably brought it up on your show, but it's astounding to me is like the majority of people out there who are investing in the typical portfolios, stocks, bonds, mutual funds, and that sort of thing. They are still playing by a set of rules, the 4% rule and all this kind of stuff that was created from data from 1926 to 1976. And that's remarkable to me because if you look at, interest rates during that period of time, they were nowhere near where they are now. Right.
Correct.
And so much of that, 4% rule and all of these rule of thumbs that the advisors tell you about are based on this idea that, towards the end there, you're going to go all fixed income. Mm-hmm. But your fixed income is going to be is going to be brutal with interest rates where they are. So,
yeah, well, at some point, maybe, maybe rates will go down. I have no doubt they will go down. But for right now, we're looking like they're going to stay low to no. I mean, right? I mean, you just have to wonder where, when they go up at some point and the effect it's going to have. For sure, right?
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits and has a premier 7-project portfolio, including its 2 flagships, Committee Bay Bay in the Arctic and Sombrero in Peru. Oren's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Oren's been called one of the best in the junior exploration sector. Oren trades on the TSX and the NYSE under AUG. To learn more, go to orenresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Oh yeah, no question. And that's the then the question is like, how quickly does that happen? I mean, I don't know that I would see it. I think we learned a lot of lessons even from the early 2000s that when you increase rates too quickly, I mean that creates a big problem too. So I mean we're in a situation right now. We've never had an economy like this. We don't know what's going to happen. The Fed doesn't know what's going to happen. They have no clue. They're just kind of, they're like in a laboratory tinkering around with something for the first time, seeing what's going to happen. But I think at the end of the day, one thing we know is that we have a lot of debt. We're going to continue to have a lot of debt, and so at the end of the day, what you can, I think, have a fairly confident view on is inflation, and maybe not over the next year, but certainly over the next 5 years. And if that's the case, I think you and I with my real estate, and I think you're definitely in the precious metals side of things, I think we'll do just fine.
Yeah, I'm inclined to agree. So how do you play these from a real estate investor standpoint? How do you play declining rates to make money and to really, capitalize on the opportunity?
Yeah, I don't, for declining rates, I think if you think the rates are going to decline, you get in a real estate right now, right? Because again, it's all based on cap rates and net operating income. So if you came in at, a cap rate of 6 and you did nothing to your property at all, and the cap rate is all of a sudden, 5.5, you've made a decent chunk of change just by dumb luck. Now, of course, we don't like to do that. What we tend to like to do is we like to buy property and say we buy at a cap rate of 6. What we try to do is we drive in net operating income from day one by, improving the properties, loss to leases, renovations, et cetera, without any consideration of necessarily what's going on with the economy per se.
Mm.
And then if we can get to, take a 6 to a 7 dynamically by just driving up net operating income and driving down expenses, then, if rates go down, then hell, we've done even better. We're going to even make even more money. If rates go up, then we have a fair amount of, we've done our job to help weather the storm. So that's kind of our play. I don't know that, rates going down in general for anybody who already owns real estate is a very positive thing for sure.
Mm-hmm. Agreed. Well, interesting times. Like you say, we've never seen an economy like this before, which is pretty remarkable when you think about it, because we have so much economic history under our belt. And for that reason alone, money has been flowing back into the United States. The cleanest shirt in the laundry, so to speak, cleanest shirt in the dirty laundry. And really, there's nothing out there, and maybe the uncertainty with these biological threats kind of drives that further, even though no country is exempt from the threat of what the coronavirus potentially has in store for us, which we don't know yet. But any uncertainty in the system whatsoever drives money to the United States. That's kind of the way it is. And a portion of that money is going to go into real estate. And so do you wait for the rates to go lower to buy? Because then your cap rate goes lower and then your cost is higher, but your debt service kind of is the same. Or you buy now when the rates are higher and hope to refinance if they go down later.
Yeah, I mean, I think I don't know that there's an answer to that. So I think and again, it has to go back to the Yogi Berra quote. What you said is, I think rather than sit there and try to guess, because I think that's what's happened for people in the last 4 years. There's just too much guessing going on. And if you guess wrong, you missed out on great opportunities to make money. So I think that you continue to, in my opinion, to behave in a way where what you're really doing is you're trying to look at property, with an opportunity to improve income all the time, and sort of look at properties, independent of what external factors may be, and look at them for what they are, and look at them as assets that you can improve and drive more income through them. And then I think it's a matter of, okay, well, if the rates go down, you're going to make more money. If rates go up, well, you're not going to hopefully lose money. So to me, the way I'm approaching real estate these days is, okay, what's the worst case scenario? If the worst case scenario, in my view, with our stress tests is capital preservation, I'm okay with that, because eventually, whether it's 12 months or 18 months, I think we'll be just fine. We don't have to, sell a property. We can just sit there and cash flow on it. So I think it's a real risk, whether you're buying, whether you're trying to time real estate or you're trying to time gold. I think you just continue to do as you ordinarily do. A lot of times that's what we're doing. And I think there's a benefit to that, because effectively it creates sort of a volume averaging type approach, which people do in, stocks all the time, right? I mean, they put a certain amount, they buy a market no matter where it is, and they're not going to guess. I think you can do sort of the same thing with real estate. And you probably can do the same thing with precious metals, right? You just keep buying, and you have a certain amount you're going to allocate towards that with every paycheck, and you're going to keep doing it. And overall, you're going to do okay, because you're buying real assets.
Right. All right. Well, I think I like your attitude here. And you always got to remember, as somebody who wrote the book called The Art of the Deal said, you always look at the downside, what your downside risk is first, and the upside will take care of itself. And
exactly.
That seems to make some sense in these markets. So, hey, Buck, just tell us, where do we find you on the web? How do we connect with you?
Yeah, so my podcast is called Wealth Formula Podcast. It's alternative investing for primarily higher paid individuals who can invest in private placements, that sort of thing. And wealthformula.com.
All right, excellent. And you'll see the link in the show notes to this interview on financialsurvivalnetwork.com. And questions or comments for Buck, myself, don't hesitate to email us, kl@kerrylutz.com, Twitter feed @kerrylutz, Facebook page, financialsurvivalnetwork.com, and sign up for a free newsletter. Buck, been a pleasure. Thanks so much.
Thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.